recording. Okay, well, again, welcome tonight to the presentation on combination strategies. And let's go ahead and get right to it. Oh, before I get started, if you want to type a question to me, just put it in the chat panel. There is another panel, I think it's called Q&A, but when I'm presenting, it doesn't show up on my screen, so I won't be able to see it. So just put it in the chat panel, if you would, okay? Okay, well, as I mentioned, tonight we're going to talk about combination strategies. And I'm going to go through an example of a combination strategy. Now, there are many different types, but tonight I've selected one that is pretty easy to understand, and it was a live trade that we actually did several months ago in our trading room, but it's a good example of some of the tactics that we combine and use that we go through in our combination strategies class. All right, so when we get started here, let's say, who am I? Well, some of you guys may know me. Most of you probably don't. But I'm a full-time options trader. I'm a retail trader, not a market maker or anything like that. I've traded options for about 15 years. I've been full-time. That's how I earn my living since 2005. Prior to that, I traded as a hobby pretty much for many, many years. I was featured in Stocks and Commodities magazine once. I've been a guest presenter on a lot of educational webinars, so maybe some of you have heard of me. I see some familiar names here tonight. So I also trade my own accounts and I manage money for others. So I've been around a little while. This is just to give you an idea of recent performance history in our options trading room. This what we do there is we have two different accounts. We have a $50,000 Reg T account that we trade with Reg T margin, and we have a portfolio margin account, which is $125,000. Those are our two model accounts. And you can see here from July 2012 through the end of October what our returns have been and what our track record is. On the yields, the way that, and throughout this presentation, when I talk about yields, what I'm referring to is the yield on the entire capital balance in the account, not on just the margin used for any particular trade. So I feel that we calculate yield the right way, the conservative way. It's easy to put together a trade where you buy an option and maybe spend $1,000 on it and make $1,000. And some people will claim they made 100% return. Well, if you have a $50,000 account and you only used 1,000 of it for the whole year and you made 1,000, you certainly didn't make 100% return. So when we talk about yields, that's what I'm referring to as yields on the entire account balance. Larry says, is this your advisor account or the account you handle? What I'm showing you here is the two accounts, the Option Elements portfolio accounts, the ones that we trade live in our trading room. These are not my managed account returns here. Those are separate. Okay, let's go right into combination strategies. What we mean by combination strategies is really how to combine option strategies or tactics for maximum control and easy adjustments. We also want to combine our option tactics to control our Greeks, and that's really the main focus of combination tactics in your trades, is being able to control your Greeks better so you can control theta, vega, gamma, and delta the way that you want to, so that it's more advantageous to your trading. In the course that I'm going to show you what the outline of it is, we're not going to be talking about just theory. We're not going to just be going back testing strategies and hypothetical trades. These are going to be dealing with real trades that we do live in the market. So it's not going to be just book learning or back testing stuff. let me move some of the stuff out of my way here. Okay, so as the name implies, I'm going to show you ways to manage your option positions using only the Greeks, not rule-based trading. For example, if you trade, a lot of people will trade an iron condor, and they will have guidelines or rules for when and how they're going to adjust that condor should they need to as the market gyrates. Sometimes that'll be, when it's, at the 25-yard line, or when, the deltas of the short option that's being threatened gets up to 25% or whatever, or as time passes. But we're not going to do that. What we're going to do is we're going to look at just the Greeks of our position and make determinations on what to do with the position. So what are we trying to achieve by managing a position solely by the Greeks? Well, in short, you can adjust the relationships between delta, theta, vega, and gamma to reflect whatever market opinion you may have, or to align your positions to current market conditions, which is probably the most important about that statement there. So in order to achieve such a state of nirvana, options bliss, which is what we're all trying to do, you got to have a blend of several tactics within your strategy, and this is managed by the Greeks. So what does it mean when we say managed by the Greeks? Well, it means managing and adjusting your strategy with multiple tactics in order to keep your Greeks in a certain relationship to one another in terms of percentages. So you want the delta versus theta, vega in certain percentage relationships to one another. As I just indicated, a lot of traders will decide when to make adjustments to positions based on parameters such as the break-even point, when price is 25% from the center of the profit zone, when down 5%, etc. Managing and trading your option positions using the Greeks is particularly agreeable when you have multiple tactics in the same underlying asset at the same time. For example, you may have a calendar in the puts, a ratio spread in the puts, and a diagonal in the puts all at the same time. Now, tonight I'm just going to talk about the major market indexes. So these ratios here belong to the major market indexes, not to individual stocks, although individual stock options, you can design the same types of guidelines for your ratios. What I like to do is I like to keep my delta to theta ratio at 5 to 15%. So in other words, I like to keep my delta divided by my theta at 5 to 15%. I like to keep delta to vega ratio 5 to 10% and theta to vega about 1 to 1, although the theta vega ratio can fluctuate, and it usually does, especially early in the trade, and I don't mind a 2 to 1. So in other words, having, say, 500 theta and having, 1,000 vega, positive or negative. All right, so we're going to take a look at an example of a combination strategy trade. And the one I'm going to show, actually I'm going to show two, was real trades that I performed in the options trading room. Okay, this was not produced with the benefit of hindsight, which would have made it a lot easier, of course, right? Okay, but before I do that, I want to tell you about the course that we're offering. Of course, this one is the first class. It's free so that you can see if this is something that you would be interested in and if you think it would benefit your trading. The cost of the class is $397. The duration of the class is 4 weeks, and we meet on Mondays and Thursdays at 6 o'clock. The class dates are starting this November 25th, then December 5, 9, 12, 16, 19, and 23, so we can get finished before Christmas. And all the classes in the course naturally are recorded, so you can download and keep them. Also, one thing that we do, which I think is really important, is With the combinations class, we also give you a free 1-month subscription to our options trading room, where we meet Monday, Wednesday, and Friday of each week, and that's where we review all of our live trades and all the adjustments and everything else that goes along with it. So you'll be able to see these actual tactics, in action during the time that the course is going on. The material that's covered in the class, or in the course, I should say, what is a combination strategy, the difference between a strategy and a tactic, what the problems are with singular strategies, like just a butterfly or just a condor. We're going to talk about iron condors versus combos, butterflies versus combos, calendars versus combos. We're going to have combinations of debit spreads and condors, combinations of butterflies and vertical spreads, combinations of butterflies, credit spreads, and calendars, and the list goes on, as you can see. We're also going to talk about ways to incorporate weekly options into your strategies as well. We're going to discuss, all of this is going to be discussing controlling the Greeks, and we're also going to talk about things like proper sequencing for entering multi-leg combinations. In other words, which ones to enter first, second, and so forth. And again, as I said, I'm going to be teaching with live examples. And we're also going to, since we're limited with live examples only to current market conditions, we will go back and show some other conditions, different time frames in the market and what we did with that. And yeah, we're also going to talk about what to do when things go bad, because not every trade is a winning trade, and I certainly have losing trades just like everyone else does. Okay, so let's go into our example, our first example for tonight. Okay, I'll spend just a minute reviewing this screen here in case some of you people aren't familiar with OptionView software, which is what I use to do all of my analysis on trades. What you see here, this is a matrix, and if you look at these blue numbers, unfortunately my mouse has got a very small little a little crosshair here, and it may be hard to see, so I'll move it around a little bit. But on the put side here, you can see that I'm short five puts in the March 18th expiry at the 2700 strike. You'll see that I'm also short a credit spread below that at 2600 and 2650. I'm sorry, 2550. And I'm long in April over here. That's what the +5 is long. So what I have here is I've got a 5-lot calendar and I've got a little credit spread. And you can see that the index that we're trading here was the NASDAQ, and on this particular day, day one, it ended down 35 points. Okay, so as we started out this, you'll notice down here at the bottom where I'm hovering my cursor, it's right up here, you'll see that our delta is 37, our theta is 392, and our vega is 641. Okay, so our delta to theta ratio is 10%, a little bit under. Okay, because we're long 37 deltas and we're long 392 on theta. Now that delta, it doesn't matter if it's long delta or short delta. Okay, we're just looking at the absolute number to determine what our ratios are. And you'll notice theta and vega are 2 to 1, roughly. So vega is almost twice as much as theta. Okay, so that was day one. This is what the graph looked like at the end of the day on day one. Now, it's not the prettiest graph that I've ever seen, for sure, but we actually started out that day, the market was higher, so it was up into here. But this is how it ended up at the end of the day, day one. Now you can tell that everything above that middle horizontal line is profit, everything below it is losses. And the dashed lines here, the one that's highlighted, the light blue one with the small hash marks, is the current day, And then the next dashed line above that is 9 days later. That's the theoretical value of the position 9 days later. And then, of course, the solid line is at expiration. This is what happened that day in the NASDAQ. The red bar there was quite a down day, huh? As you can see, it opened up and then sold off down. Okay, so we're going to go forward in time, and you'll notice here that on our matrix that March now only has 15 days to expiration, so this is 3 days later. And you can see that what we did here was we added 3 more put credit spreads here. Now, we did that during the day, and you'll notice something about this screen capture, and that is that all of a sudden, if you look down here and look at our Greeks, you'll notice that our delta and our theta is way out of line, right? We ended up minus 261 deltas versus our 126 theta. And look at Vega. Vega's increased quite a bit. So we have to do something about our position because our Greeks are now out of line. This is what the position looked like on the graph. And this is what the market had done over those, next 3 days. You could see that it ran up quite a bit. This green area on the right-hand side of the graph is the profit zone, and the red, of course, is loss zone. Okay, so here's what we did to correct those deltas. Now remember, we like to keep our delta to theta ratio at 5 to 15%, and we really like theta Vega 1-to-1 if we want to neutralize Vega. We don't want it to get so long Vega like it was on the previous screen. So this was the adjustment that we made. You know what? I think I missed a... No, I didn't. Okay. This is the adjustment that we made here. Now, you'll see that I originally had a 5-lot calendar, right, at 2,700 strike. Well, what I've done here is I've removed one of the long puts in the April expiry, and I moved that into the front month, thereby creating a 1-lot credit spread at the 2,700 put, 2675 put. Okay, and I now have a 4-lot calendar. I also added a debit spread in the calls to support the upside potential of the market. So here, what we have now is we have a 4-lot calendar at 2,700. We have a 1-lot credit spread at the 2,700, 2675, and we have an 8-lot 2,600, 2550 credit spread, and we have a 1-lot debit spread in the calls. Okay, so we have 3 different things going on here, but they're all being treated as one position, and you'll notice that our Greeks here, you'll notice that our delta is minus 21, and our theta is 239, and our Vega is 787. So our delta theta ratio has corrected itself, or we corrected it, so now it's within the right parameters that we like. Okay, now you can see how this trade is evolving. This is what the graph looks like right now. Still have the main components of what it looked like originally, but notice the graph area to the right is starting to take on a new shape, right? Well, one of the things that we're trying to do is as we no audio. Let's see. Surely I have. Well, my microphone's working. Hopefully everybody can hear me okay. audio broadcast and reopen it. Okay, everybody's got good audio. Okay, yeah, if you lose audio, you might have to close and then reopen the in here. Okay, so anyway, what I was saying is that what we're doing is we're developing the trade, and we're going to slowly, what I want to do is slowly raise the at expiration line on this graph to the right of where the current price is. So I'm slowly lifting that up as we go along here to create a much wider profit zone and control the Greeks. Okay, let's go to, whoops. Okay, so here's the price chart again, and you can see that, you know, we've been tooling around the same little area. Looks like we might go higher, who knows. But that's the graph, the price chart. I keep clicking on that, sorry. Okay, so another 2 days went by, or 1 day. Okay, now what we're doing is we're still keeping our Greeks in line. What I've done here is you can see that the market's up pretty hard. It's up about 40 points, 39 points that day. So what I'm doing is I'm relieving myself of part of that 2700 calendar, because if you notice, the price of NDX is now almost at 2800. So to control the Greeks, what I've done is I removed 2 more of the long puts from the calendar and I added them to the front month again. So you'll see that this is like one way to adjust a calendar, is to remove part of the longs and place them as part of a credit spread. So I've created a credit spread here at the 2700 2675 put, but I didn't have to sell any more options. Well, naturally I had to sell the 2 of them in April, but I didn't have to sell any more at the 2700 strike. So what I've done is I've moved 2, I sold 2 of the April 2700 puts, and I've bought 2 more of the 2675s. So now I have a 3-lot credit spread at 2700 2625. I have a 2-lot calendar. Remember, that calendar started out as a 5-lot. I still have my 8-lot credit spread in the puts, and I've got my 1-lot debit spread. Now, you know it's a debit spread because the options I'm long are closer to the money than the ones I'm short, and it costs me a debit when I bought that. So that's a debit spread. Our Greeks, delta is practically 0, right? That's the way we want it. Our theta is 127 and our vega is 319. So our theta to vega is a little over 2 to 1, but close enough to call it 2 to 1. And of course our delta is less than 5% of our theta. So we're neutral when it comes to price movement, at least for a little while. Okay, now, by making those adjustments, this is what the graph looks like now. You can see that what I've done is I've flattened out the entire center area of this trade. You'll notice that the at expiration line, the solid line, notice how it dips below like even the current day theoretical line and also the 5-day forward line. See that solid dashed line, solid dashed, I don't even think there is such a term. The darker blue dashed line is 5 days from this day. And the light colored, light blue line is the current day. And of course, the solid one is at expiration. So you'll see what I've done there by lifting part of that calendar, in other words, converting part of the calendar to a credit spread. I was able to lift up the entire sort of middle of my graph and you know, the upside of the graph if the market continues to rise. And this is what was going on. You'll see that, you know, we've got a really, really big profit zone around, you know, nice price band there. Okay, so let's move forward 2 more days. Now what happened here is I removed the remainder of the calendar, okay, because the market was stabilized up there. The calendar was at 2,700, and it was really just costing money as the days went by. So in order to affect the position, I removed the remainder of the calendar. So you'll notice that I no longer have any long puts in April. Well, what did I do with them? Well, I moved those longs, all of them now into the 27.25 strike. Okay, remember I moved those one by one. Well, I moved one first, then I moved two, and then I just moved the last two here. So now what do I have? I have, also here, I rolled up the put credit spread. Okay, the 8 lot, remember it was lower down here? So what I did was I rolled the 8 lot put credit spread up. I consolidated my strike, so I took the short 8, which was at 2,600, and I moved it to 2,700. And of course, you can see what I did with the other 8. I moved those up to 2,650. Okay, so I moved the 8 lot credit spread up 100 points. So now what I have is I still have my 8 lot credit spread. It's just at different strikes. But I also have a 5 lot credit spread. See, if you take that minus 13, the 13 number here, and you take 8 out of it, you're going to be left with 5. So I've got actually 2 credit spreads there. You could look at it that way. And I added a 4 lot credit spread in the calls. And look at the Greeks. The delta's 14, the theta's 400, and Vega is minus 643. So all those Greeks are in the relationships that I like. Now, how did, you may be thinking, well, how did you, decide on these adjustments? Well, basically I look at various different tactics that I could employ, and I see what's going to be best for my Greeks. And if I have a calendar, this is one of the ways I like to adjust the calendar as the market moves. I don't like to replace the calendar. In other words, I don't like to close it and move it up or down. I'll simply convert it to credit spreads or debit spreads. It's an easy way to control your position with very, small numbers of contracts. Whoops. Okay, so now the position looks like this. Now you see that it's starting to look a lot like, the shape of a condor, with the exception of that indentation in the middle right here. And here's what the market had done. It, just kept going up. All right, the next day or 2 days later, there's no changes, but just notice our Greeks, the delta's minus 7, the theta's 337, Vega is 531. So again, delta is less than 10% of theta, and theta Vega is, a little bit greater than 1 to 1. Now, see, this is also, keep in mind, this is a way to neutralize your Vega in your position. By keeping your Vega about 1 to 1 with theta, you can effectively neutralize it. Now, obviously, it's not going to prevent, gains and losses according to the increase or decrease in volatility, but it's going to offset it with the Vega. So a 1 point rise when you're short Vega like this, a 1 point rise in Vega one day is going to be largely offset by your theta. So it'll have a sort of a neutral effect. And that's what it looked like that day. Nothing much difference except you just gained some more premium, and the market's going sideways. All right, so as we cruised on in towards expiration, you'll notice that what I did finally was I removed the debit spread, which was causing that indentation in the middle of the graph. And our Greeks are under control again, 11, 367 on theta, and 175 on Vega. And the position ended like that. Oftentimes, with combination tactics, the position will wind up looking like this, sort of like this, very, close to the end of the trade. That's how I like for them to wind up. So instead of keeping, a sharp peak of potential profit, I like to flatten it out slowly as the trade progresses towards the end. Okay, I think that's that's how the market wound up. So we started it, right here on this bar. It went way down, up, back down, up, and sideways. Kind of common, right? Okay, so I think this was the day we closed the trade. This is day 16 of the trade. I closed out the 8-lot put credit spread, so this is what was left. And I think we just let those expire. Can't really remember, but I think we might have just let those expire. And it looked like that. Pretty much came to fruition. I think that's my last slide there. Yep, okay. So, let me back up and go back to the beginning here. Oh, there we go. Sorry, guys. There we go. There's the beginning. Okay, let's stop there for a second. And I know that there's probably some questions. I know that I went through that relatively quickly because I know your time is valuable, so I don't want to linger on the slides on each one of them. But let me see if there was some questions here that I can address, and then I want to show you another example. Let me see. I've got a lot of questions here, guys, so let me make this chat bigger. Let me just skim through these. Good question. Let's play one. Okay, Tom says, why is Reg T doing better than the portfolio margin? Well, it's a good question. The last 3 months, I haven't been utilizing all of the, and what he's referring to, guys, in case you missed it, he's referring to the, let me find it. This. He's referring to what I've showed as our last 16 months of trading results. The reason that the Reg T has done better is it had 2 really good months here. The last couple of months I haven't been using all of the available capital in our portfolio margin account for a couple of reasons. Number one, mainly because of all the hoopla going on surrounding the budget deficit. And in fact, I was out of the market for a couple of weeks in October. That's one reason. The other reason is that the trades, most of the time they differ between the Reg T account and the portfolio margin account, but they've actually been the same for the last couple of months. And I haven't had the opportunity to really increase the size of the trades for the portfolio margin account, so it has suffered a little bit of lag behind the Reg T account. Now, I have had some losses this year. Most notably, July was a big loss. In fact, it was the biggest loss I've had in 3 years. But it is there. It's not pretty, but we've clawed back from there. But it does happen. That was well, it was a circumstance where our trade was going into expiration week, and we had some really big moves in the market, and that's what destroyed our position. But anyway, we do have losses. But as you can see, not many. Okay, let me go back to my first, there it is. Okay. Um, Thinking about that. Yeah, where's my questions? Let's see. If you lost sound, okay. Sorry, guys. I got to skim through these. Do you keep adjusting? Okay, Iguana says, do you keep adjusting every day to keep the Greeks in desired ratio? No, we don't have to make adjustments every day. In fact, ideally, I like to run my trades where I don't make very many adjustments at all. In fact, often I try to sit on my hands to avoid over trading, but I also try to design trades that don't require adjustments every day. But with that said, there are times when we do make adjustments, say every day for several days in a row, and that's usually when the market is moving in one direction consistently, day after day after day. Or if there's some big news event that would cause us to have to adjust. But we don't make adjustments every single day. I'll let the Greeks fluctuate during the day. So I don't panic and make an adjustment if the delta theta ratio gets above 15% during the day. In fact, sometimes I'll let it go to 20, 25 during the day to give the market room to do its gyrations. So we try not to overtrade, but when the Greeks of the position begin to get out of the guidelines that I've presented earlier, that is the indication that positions need to be adjusted because they're in danger of either, number one, giving back profit you've already earned, or worse, going into a loss on the trade. To keep every Greek's desired. Also, you have to pay to buy 226.75 put after selling 27.99 one out. 99 one out. Yeah, right. When I was moving the calendar here, I was selling the April 2700 and buying the March 2650. So all I was doing is slowly converting the calendar trade into a credit spread. So I was just morphing it, from one tactic to the next, just slowly. It appears one needs a low commission broker like IB to apply these combination strategies. No, commissions are negligible no matter where you are. The important thing is slippage on trades. Now, that's another reason why in combination tactics, oftentimes I may have, say, a large credit spread, large number of contracts, for example. I don't want to move those things up and down. What I would rather do is control the position with just a couple, one or two or three other contracts. So oftentimes the adjustments I'm making to combos to control the position is with small numbers of contracts because it's easier to get filled, it's quicker, and, commissions are lower. But, commissions, I think I pay 80 cents a contract or something. So commissions are pretty low. Imagine if you have a iron condor, you're going to have 4 wings, and if you have 10 contracts, that's 40 contracts. And let's say that you're trading an iron condor and your adjustment tactic is to move the whole thing up if the market rallies, or move the whole thing down if the market goes down. Well, you're dealing with 40 contracts every time. And if you have to buy them all, buy and sell all of them twice, that's 80. Whereas like the adjustments I made here, they were small, ones and twos at a time. I find that to be easier to control. Or own your own brokerage, yeah. It's even better. Yes, it is recorded. This is recorded. Do you trade one big position on one underlying or combine different underlyings and weight them? No, I don't trade different underlyings and weight them together. I find that that's just too hard to keep it balanced. A lot of times I will trade just one underlying instrument at a time. I may have two different trades in that instrument at one time, but sometimes I'll also have two different indexes that I'm trading at the same time, like vis-a-vis the the NASDAQ or the RUT, or both of those at one time. This example happens to be in the NASDAQ, but I'm going to show you something in a minute in the RUT, the Russell 2000. So did it make money after commissions? Yeah. Here's the here's a final tally here, okay, on this trade. You can see that the gain was $3,800, $3,896, and the commission was $80. So the commission's already been taken out of that gain and loss. And the maximum margin used on that trade, I think, was about $35,000 or $40,000, roughly. Let me go through these real quick here. Why did you do the calendar initially? Well, I did the calendar initially because I didn't want to have an iron condor. I don't particularly like to trade iron condors as a sole. Let me find this as a sole strategy or tactic. Let me go to the beginning here. Where is it? There it is. Okay. You'll notice that I started out this, I had a put credit spread. You're probably used to seeing those, but you're probably used to seeing also a call credit spread. Well, I didn't want to sell a credit spread in a call because I didn't want to have a condor. But also, I didn't want to have just a credit spread in the puts. So what do? Well, I didn't want to be too negative. I wanted to control my vega. I didn't want to be really negative vega. So my natural conclusion was to enter a calendar here at the money. See, we started out at the money. So my primary trade here, my primary tactic is the calendar to start with an enhancement to it by adding that credit spread on there. So it started out as a combination instead of just a calendar. Somebody says they need a drink. I've got a cup of coffee here. Hang on, let me take a sip. Coffee. I shouldn't be drinking coffee this time of night. You've come a long way on your adjustment tactics. Oh, thanks, Lauren. Yeah, it's been a long road of trading. That's for sure. How do you keep track of the overall realized P&L when you could be making or losing dollars on each adjustment? Does OptionView automatically do that for you? It's a good question, Darren. Okay. Yes. Well, it automatically does it for you if you select the right settings for it, which I do. I want you to notice something. Okay, look at this. I wish I had a drawing utensil. Look at this down here at the bottom of this screen. You'll notice here where it says gain or loss, and it shows that I'm down $957. Okay, in a minute I'll change to after I've made an adjustment, and you'll notice there'll be a little asterisk next to this gain and loss. It'll be about right there. That asterisk means that it's considering all previous open and closed positions, okay, or trades in this position. So yes, it keeps track of it. What you see is not, just what's the gain or loss on what's left in the position after adjustments. It takes into account all the adjustments. That's the only way to do it. So when I go to the next slide, let me go to where it's at. There we go. Okay. Notice I've made a couple of adjustments here, and I've closed out one of the original options that I had. One of the original ones right here in April, I sold that one and I moved it down here. So notice this asterisk, okay? Since I've closed out one contract of the existing trade, it now calculates here and it gives me the running P&L on the closed position and the open position. See? So it keeps track of it. You have to do that. Otherwise, you won't know where you are with the P&L, as Darren indicated. How much commission did this cost? Well, right here it shows 41. I think that was the highest that it got to. It's 41,000. And there's ways to reduce the margin requirements too with the credit spreads. But that's what this one was. I think the maximum was 41,000. Remember, we're only in it 16 days too. Who does your taxes? I think I should get them. Taxes? I've never heard of taxes. Do your managed accounts perform similarly? Similarly, yes. So do you ever adjust position from a credit or debit spread to a butterfly? Yes, of course. Yeah, this example just didn't have one. But yeah, we use butterflies. Keep in mind, butterflies are nothing more than a debit and a credit spread. So yeah, I mean, all you have to do is move these around a little bit and you could have a butterfly. Yeah, we utilize butterflies. Keep in mind, this is just one example of all the things we're going to talk about and discuss and show in this course called Combination Strategies. All right, let me get through these questions here, and then I want to go on to something else. Can the strategy be automated through conditional orders, or is one expected to sit in front of the computer during trading hours? I suppose that it could be set with conditional orders. You'd have to really know your broker platform pretty well to be able to do that. I personally don't have conditional orders because I'm a full-time trader, so I'm usually always within arm's reach of a computer. But I suppose that you could do that, sure. Because also in our trading room, we go over the potential adjustments to a trade ahead of time. So you could plan accordingly, I suppose. Is it too risky to make adjustment in a smaller account? Do you focus on the Greeks more than technical analysis indicators? Do you place stops? Okay, no, I don't place stops because there's no reason to with this type of trading. The stops generally would be used for directional trading. My stops, so to speak, okay, are mentally imposed based upon the way that I want the Greeks to be in association with one another. So, I know that when my delta to theta ratio gets above 20%, that I need to consider some adjustments. So effectively, you could call that a stop, but it's a mental stop, I guess. No, it's not too risky to make adjustments in a smaller account. You just have to use smaller contract sizes, that's all. Of course, I know that it's hard to split one contract, but you can do it actually by trading the minis. Where do we get that commission? Well, I use Interactive Brokers. Pay 80 cents. I could probably get it less than that, too. I've been with them a long time. I just haven't looked into it. This started 18 days out. Is that how you start them all? No. No, this one just happened to be 18 days. Generally speaking, longer-term trades, like to me, a longer-term trade is somewhere, 30 to 40 days. That's a longer-term trade, but quite frequently I'll trade, in time frames under 30 days. It just varies. It varies on market conditions. It varies on what other trades I may have. It varies on, when I close the last trade. Sometimes we're in trades for a week and close. sometimes 2, sometimes 3, sometimes 10 days. It just depends on conditions. Rod says, what determines how you set your Greeks to begin with, positive Vega or negative Vega? Okay, well, I can answer that one. That basically, I keep track of the volatility index. So I'll look at, say, if I'm trading Russell, I'll look at RVX and I'll just say, where are we, in relation to the last couple of months or even the last 12 months? If we're in the low end of the range, which we are now and have been, I don't want to be really, really short Vega. So I don't want to have just an iron condor hanging out there with a massive short Vega, because I can get hurt that way on a steep rise in volatility. So I want to be leaning neutral to long Vega. And conversely, if Vega is high, if implied volatility is high, then I want to be short Vega. It makes no sense to be really, really short Vega when volatility is at the very low end of the range. And it makes no sense to be really, really long Vega when volatility is in the high end. It's easy to determine the low end of the range, but sometimes it's not so easy to determine the high end of the range, especially on big spikes. Do you use a calendar to start out always in market conditions? No. No, I don't. In fact, I prefer diagonals over calendars generally. This one just happened to be a calendar to start with. And I chose this example actually because I knew that all you guys would be familiar with calendars and credit spreads. So I didn't know how many people actively trade things like diagonals, so I didn't want to present that tonight. Although I'm getting ready to show you one of those because I changed my mind after I put this together. I thought I'd show you something current that we're doing right now. What determines how you set your Greeks to begin? Oh, never mind. I already read that. Thanks for the explanation. Looks like these trades require a lot of margin and adjustments from start to end date. Depends on what you call a lot of margin. This particular trade is in the NASDAQ, which has only 25-point strikes. So generally speaking, in the NASDAQ, margin requirements are a little bit higher. But you can also adjust the numbers of your contracts. Whereas in RUT, you may trade multiples of contracts. In the NASDAQ, you don't need to trade that many to achieve the same results. And it doesn't require a lot of adjustments. I only made, just a couple of adjustments in 2 weeks on this trade. And most of those were closing adjustments. You'll notice I didn't do very many opening adjustments on the trade. We have a nice, easy way I could see working with you if I get some brain RAM. Okay. How about double calendar spread, and do you initiate a trade taking some bet on market direction? Sometimes I will. Sometimes I'll lean one direction or the other. But the way that I do that is what I'll do is I'll still protect myself in the other direction, the opposite direction that I expect it to go. But I'll put my oversized profit zone in the direction that I believe the market may go. Now, I don't always have a directional opinion. I try not to, but sometimes it screams at you and you can't ignore it to have some type of a directional bias. But I don't do that at the expense of the other side of the profit zone either. What are your favorite underlying instruments? Okay, basically my favorite instruments are the Russell 2000 Index, the NASDAQ, which can also be traded as the futures, which is NQ, which is a mini-sized contract, and things like Treasury notes and oil, but I haven't traded notes or oil lately because of conditions present there. So you could suffice it to say that mostly with my combinations, you're going to see Russell 2000 Index and the NASDAQ 100. But there's a surrogate for the NASDAQ 100 for smaller account sizes, and that's using the NASDAQ futures options which is the symbol N as in NASDAQ, and then Q as in quantitative easing. Is that one word or two? That's two. Okay, these questions are just going on and on. Let me see. I wanted to get, let's see, demo. Could you demo butterfly adjustment? Well, I don't have a butterfly adjustment here because I don't have a butterfly. How long do the trades last? Some of my trades are a week, some are 2 weeks, some are 30 days. It just depends. I've got other trades that are only 3 days, that are automatic trades that I do every single week. But that's a different topic for a different day. But you'll see that in the trading room if you decide to join us. How do you decide what type of trade to make when you need to adjust? Well, I look for the simplest thing to do first of all, but I also look at what's going to affect my Greeks the way that I want it to. You know that a calendar trade is a positive Vega trade. A credit spread is a negative Vega trade. Okay, and each one of those have certain delta characteristics. So I just simply look at the choices available to me and how I want my Greeks to be effective, and that's what I choose, how I choose what the adjustment's going to be. I also look at the graph. So, visually, I want my graph to look good. I don't want to haul off and do something that's going to make the graph look really weird. So it's all part of that. When do you decide Vega does not indirectly choose a value for theta based on Prever ratio? When you decide Vega does it not indirectly choose a value for theta? I don't understand that question. Hang on, let's. Do I foresee the VIX spiking in January? Yes, I do. Liquidity can be an issue on NQ. ES is good though. Yeah, that's a good point, Sean. Sometimes NQ can be a bit thin. ES, on the other hand, which is the E-mini for the SPX, S&P 500, has got so many contracts it's almost ridiculous. Gandhi says, do you adjust Greeks during market hours or do you take a decision? Yeah, I adjust during market hours. But, I analyze things all during the day, and of course I look at things after hours occasionally. But no, I adjust them during the market hours. He says at the end of the day. No, I don't just wait till the end of the day. No way. I adjust whenever it's time to adjust, no matter what time of the day it is. And you know what? In our trading room, I haven't even told you guys much about our trading room, but listen, in our trading room, all of our subscribers get text messages and emails on all of our trades anytime I'm getting ready to make an adjustment. So before I make an adjustment, I send out text messages and emails to people. That's part of our service. So when people are following our trades, they see what adjustments I'm doing ahead of time. And obviously we discuss those ahead of time as well in our trading room that meets Monday, Wednesday, Friday at 4:15 each day. How'd you come up with the Greeks ratios? That's a good question. How about a double calendar spread? Yeah, I do double calendars too sometimes. How did I come up with the Greeks? Well, trial and error, quite frankly. It's, over a long series of trials. I used to manage positions like most of you guys probably do, which is, I want to sell a 9 delta, I want to have a calendar, add another calendar, if the market moves here or there. Butterfly, start out with a bearish butterfly with, 25% and of your margin of your capital, and then, add 2 more in tranches as the market moves, all that stuff. Okay, but I've found that just managing by the Greeks works the best for me, and I've come up with the ratios that apply to the indexes, and they keep you, they help you get the most out of your positions. Okay, now let me show you something else. Okay, this is one idea, so you can get an idea of what I'm talking about when I'm talking about combination tactics. So I want to show you something else. I promised you I'd show you ways to use weekly options. Okay. This is the members area of our website. This is where our classes are, okay? So like here's the combination strategies class. That's actually the previous one I taught. Here's a class on weekly options. Here's our trading room. If I click on that, you'll see in here that we've got a library and we've got trade details and other things. The library consists of all of the recorded trading room sessions, as you can see on here, okay? Actually, I've only got 10 pulled up, but if I were to pull up 100 of them, you'll see that they go back, okay? So we've got them all recorded in here. Now, what I want to show you is if I go to trade details, let's go to trade details of the Reg T. Okay, this is where we post, daily our trades as they progress, screen captures of them. Now, let me go to the current trade. Okay, this is a current trade that we have, and I boxed this in so people could see it, our subscribers better. What we have here is this is a Russell 2000 index, and we've got a double diagonal. Okay, we've got a diagonal spread in the calls. As you can see, we're long. Well, let's start over here. We're short the weekly series, which expires November the 22nd, and we're long the December options that expired December 20th. Okay, so we're short the weeklies here, the calls and puts, and we're long the December options. Okay, and that's a double diagonal, and this is how the trade started out. Notice again, if you look at our Greeks down here, our delta's minus 42 and our theta's 752 and Vega's 1800. So similar Greeks as the other as the other example. This is what where's my graph on the 14th? Right there. That's what the trade looked like the first day on the graph. Actually, this is the second day of the trade. So that's what it looked like. You'll notice here, we started that trade on the 13th of November. You'll notice on the 16th here, you'll notice that we made an adjustment. Now notice my commentary here. It says double diagonal position, the delta theta ratio is getting a bit high at 23%. But the original decision-making point that was identified when we started the trade, in other words, when we started the trade, I had a visual identification of when we would make an adjustment to the trade based on price movement of the underlying. I said, even though that's not been reached, still I'm looking to adjust the trade on Monday if we continue higher by rolling the put spread up 1 10-point strike. Also, we're very long Vega. So any pullback combined with a rise in vol is going to be very beneficial. Okay, so this is where we were that day, and I'm pointing out that this is the line that we're identifying that we're trading for, which is several days forward. On the legend, you can see it's 3 days from this day. We made an adjustment. You can see on, we cruised through the 18th. On the 19th, we made an adjustment to the trade. Our trade looks like this now. What we did was we did that adjustment that I talked about just back here. Actually, that's not the adjustment we did because we didn't have to make that adjustment. What we did was we rolled, sorry, I forgot. We actually rolled this because this is what I call a time traveler trade, okay, which is really why I wanted to show it. What we did was we rolled our shorts from the previous week's expiry to the next one. Let me go back and show you. This is how we do it with a time traveler trade. Wait, that's not the... Just a second, guys. Sorry. Go back to the beginning. Oh, we hadn't rolled it yet. Hang on. Sorry. I'm losing my place. Oh, here we go, right here. Okay, here's our position after we made the adjustment. So what we did was, this is another thing you'll learn with me. This is a time traveler trade, okay? It's a double diagonal, but what are we doing? What we're doing is we're starting out with this weekly option. We're selling the options here as part of the double diagonal. Then as time progresses, we move the shorts to the next weekly expiry, and then to the next weekly expiry, and so on, while all the time trying to maintain our longs in the same spot. So, this shows this is the rut. We traded all the time, and this is an example of what we're doing right now, which really, by definition, is a combination trade. It just so happens that it's a combination of two diagonals instead of, say, a credit spread and a diagonal and that kind of thing. Okay. Let me go back to, whoop, that's not what I want. Where was my other screen? Oh, there it is. Okay. All right. So I wanted to show you that, just to show you, kind of what we do. In the class, I can't go over everything tonight, obviously, because the class is 8 sessions that are an hour to an hour and a half long each. And they're complete with PDF files of the information that we discuss. And also we go, through examples of the I'm talking about. I wanted to show you what the members area of our site looks like, because there is a lot of information there. And of course, if you decide to join us for this class on combination strategy, you get access, a 1-month access to the to our trading room, and of course our website, where we have all the screenshots. You can look at our previous trades, current trades. You can get trade alerts for our current trades, and also attend the classes. So really, if you think about it, the combinations class is 8 sessions, an hour long each, plus during that 4 weeks, you get 3 trading room sessions each week. So that's 3 more hours a week. So if you add it all up, that's about 20 hours of education and live trading. So it's actually a really, really good deal. It's very fairly priced. I am from India. Do you think Greek ratio is okay for any market? Well, now I don't know. I know that it's good for the U.S. major market indexes, but other indexes, you'd have to come up. If I was going to trade another index, say an overseas index, I would definitely probably come up with different Greek relationships or Greek ratios. Yeah, you need a Greek for hyperinflation, right? That's a good one. Okay, I've gone through our allotted time here. So I just wanted to see if there's any more direct questions about the presentation tonight. Now, listen, I know that there's a lot of information. I went through it pretty quick because, again, I know your time's valuable and you don't want to stay up all night. I would like to ask you to join us for this class. Again, it's going to be a lot of great material that will help you take your trading to the next level. Of course, we always have a money-back guarantee. That is that, if you join the class and you decide it's not for you, of course, you get a refund. I do think the class is valuable. I've spent a lot of time and preparation on it. I do practice what I preach. I trade live with my own money in the options trading room, and people, our subscribers, can verify that. We keep our track record. Everything's transparent, and it's a great learning environment. again, I'm a full-time trader. That's how I earn my living. And I think it'd be very valuable for you guys. I think you would enjoy it. I have one more little bonus. But first, do you have a video on your weeklies classes, Tom? Yes, we do. We just finished the weeklies class, which was a month long, and it's all recorded. And you can buy it if you want. Sure, it's available on our site. It's $397 also, and it covers all of our, well, covers not every single possible weekly trade, but it covers most of them on how to trade the weeklies. I think you'll be surprised. Trading the weeklies is not really, the proper way to do it's not really the way most people think. But yeah, it's a good class, and it's there. It's available for you. How many members, did I see? Jeremy wants to know how many members we have. Well, it fluctuates. We average at any time about 50, roughly. Isn't it extremely risky to place a $66,000 double diagonal trade in a $125,000 trading account? What would you do in the face of a catastrophic market event? Well, every time I do a presentation, I get the catastrophic market event question. Well, first of all, a $66,000 double diagonal and a $125,000 trading account is only using 50% of the margin, and I prefer to use more of that than 66,000. So it's not uncommon for me to have, 80% of the capital being used in margin at any one time. So with that said, a catastrophic event. Okay, well, a couple of things. If there's overnight risk to be taken care of, I can use the futures market. So the futures trade almost 24 hours a day, not quite, but almost. So futures can be had. You can also utilize what we call insurance on trades. Insurance can come in a variety of forms. The easiest, or what most people are familiar with, is buying extra long calls or puts out of the money. What people would, well, floor traders commonly call them units. Okay, what they are is it's basically options that are pretty far out of the money that are trading, they're like 20 cents, 30 cents, 50 cent options, which are there for crash control. So that can certainly be done. So there's a variety of things that you can do, obviously, to try and mitigate losses that could occur in some type of a catastrophic event. Thankfully, catastrophic events don't occur that often. We don't, by virtue of catastrophic, they're usually unforeseen. There's really no trading method if you're going to be in the market, even if you're trading stocks or commodities. Well, especially if you're a stock trader, you're generally going to be long or short. There's no real way to cover all potential outcomes like that, with the exception of, if you have a bear spread, what's commonly called a debit spread in the puts, and that's it, then you don't have to worry about a catastrophic event. Okay, but it's a directional trade, and if the market goes nowhere or only goes down a little or goes up, you lose. So, by having a double diagonal, for example, a double diagonal has a finite loss. So anytime you have wings or your shorts are covered and not naked, then you're going to have a maximum loss. Could that maximum loss be reached? Well, theoretically it could on a, quote, catastrophic event. However, if you go back and model any gigantic downward move in and you look at what a put diagonal spread would turn out to be, the volatility, the implied volatility in the options that you're long are going to skyrocket. And it's not even unreasonable to think that that position would turn a profit on a massive move down. Now, you're talking a catastrophic massive move. And we don't have one of those except for, well, the flash crash was pretty quick. But, you know, you could look at 2008 as an example. But I get that question a lot. And, of course, it's on traders' minds. So those are some ideas for you to try to deal with that. Stop loss would have worked in other types of trades. Yeah, of course. Yeah, I mean, you can always put in some type of a contingent order to buy your options back or whatever. But the problem is you can't do that when the market's closed. Do you provide slides, training materials part of the class? Yeah, I do. Yeah, like this is a slide presentation that's converted to a PDF. Yeah, we have all those. Okay, Lauren, yeah, good to see you too. Hey, okay, guys, well, that's all I've got for tonight. I don't want to keep you guys any longer, but let me go to the end here. Okay, here's what it is. If any of you got, well, however many, all of you guys that are with us tonight that sign up for our class, I'm going to give you a free one-on-one with me to pick my brain. That's assuming you want to. Sometimes my wife says, I don't want to be alone with you. No, anybody that's with us tonight signs up for the class. All you got to do is send me an email, and I'll arrange to have a one-on-one session with you, and we can spend some time and talk about, any of your questions about options, what your goals are or what you've had trouble with or anything that you might want to do one-on-one. You're welcome to if you sign up for the class. Also, of course, you get the free 1-month subscription to the trading room, and here is the links down here where you can sign up for our class. Now, I hope you guys will consider it. I hope I gave you some good material tonight that piques your interest, and also hopefully I've given you some things that you can walk away from tonight and use in your trading. So let's see. Okay, well, I don't see any more questions. It's almost 11. So at any rate, we also have, we've got a free members area where we put some good free tools and stuff. If you go to our website, www.optionelements.com, there's a link to our free members area. It's not, we don't have to pay a subscription, and you can get some pretty cool stuff on there that can help you out as well. So I hope you'll consider that. Okay, well, listen, guys, I want to thank you all for being here tonight. And there's that's the link to our free members area right there in the chat. We will send out a PDF of this class tonight, along with the link to the recording to everybody, in case people had to leave or if you'd like to review it again or whatever. And again, I hope you consider joining us. Thank you, Jim. I hope you consider joining us for our class. And maybe Chris Smith will have me on again to talk about some other things, maybe weekly options sometime in the near future. Okay, guys, thanks again for spending your time with me. I appreciate your time tonight. And I hope you all take care and enjoy the rest of your evening with your family. Okay, good night.